What are you thinking it's coming out in the future? Is like the Biden clan going to be getting rid of that 1031 exchange?
They
A
get
lot
rid
of
of the 1031 exchange. They want to get rid of step up in basis. And that's going to affect all of us. That's huge. For anybody who has substantial amount of real estate, it's going to force you to have to get rid of your real estate during your lifetime because it's not going to step up, which means if you've depreciated it, you're going to have some substantial recapture if somebody sells it after you've passed. And the step up in basis in English just means if I have a building that I've depreciated or a piece of real estate or stock, say I've owned stock for 20 years and it's gone up in value, the day I pass, the basis steps up to the fair market value on the date that I pass. So if I have a building that I've depreciated and my basis might be a little bit of land, maybe it's 100,000, it's $1 million building. Right now, if I pass, the basis steps up to $1 million. I live in a community property state, so even my spouse could sell it the day after I die and pay zero tax, no recapture. If that goes away, then assuming that somebody had to sell an asset after somebody passes or wants to because they don't want to manage it and they sell it, now they're going to pay recapture in capital gains on that. So they're going to pay up to 25% on the recapture and up to under Biden, it could be 39.6% on the capital gains. So it's a pretty big hit. Now, the other side to that is if it's real estate, not only does the basis stepped up, but you can re-depreciate it. So you can go back and write it off again and you lose that. So that's flying under the radar. And that's the one that I focus on, saying that's the one that's going to have the biggest impact. People who are investors are going to get punished under that. The old strategy was accumulate real estate and capital assets, 1031 exchange your real estate into more real estate, lever it, use the proceeds if you need to for other things, and then pass away, and you don't have to worry about any tax. And they could either re-depreciate it, so they're not going to pay any tax on any of the rents for a long time. So you're going to depreciate it again after they've passed at that higher amount, and all of a sudden they're getting huge tax benefits, or they sell it and they pay no tax. And so there was always that kind of the silver lining, especially in community property states where the first spouse, everything steps up. Dad passes and mom can sell the stock and not have to worry about getting hit with capital gains. Now, mom could be getting hit with as much as 39.6% federal, plus the net investment income tax, which is 3.8, plus their state taxes, which can be as high as 13%. So you could be in a scenario where you're paying 50 some odd percent. It gets a little ridiculous.
So is the solution either to wait until a different party is in there and changes the law again, or some kind of dynasty trust or a trust that irrevocable trust that owns the assets so it never does a step up?
Yeah, that's a tough one because no matter what, if I put it into trust, the basis is the basis. I'm done. So there's really not much of a strategy on the step up. You can do what's called a deferred sales trust on substantial assets where you spread it out over time and you allow a installment sale essentially, and then you step up the basis and you sell it and avoid the tax immediately, but you spread it out over, let's say, 20 or 30 years. There's still some strategies that you can do to lessen it. Realistically, under those circumstances, it's just you're sitting down going option A, B, C at the time. I've seen people make changes where they were scared to death. So I'll give you a good example. I had a client, it was siblings. So there was 5 siblings. And the dad had a office building, and this particular office building was in Ohio, but it had substantial value. So they were worried about the estate tax. So he started giving away interest the building was in a limited partnership. So this is back in the day when limited partnerships ruled the world and not LLCs. And he would give his kids these interests. So he transferred the entire building to his children before he passed. He'd owned that building for going on 40 years. The basis was tiny. And then when he passed, it was in the year that they had the unlimited estate tax exclusion. So there wouldn't have been an estate tax at all. And he would have still been underneath the threshold. It was multi-million-dollar building, but he had given it all to his kids. So his kids said, hey, we're going to sell it. Their basis was his basis, which was almost zero. So they got hit with this huge tax bill that would have been avoided completely had he just done nothing. And so I tend to look at attorneys that are pushing people to do huge gifts or make big changes. And I say, don't do that. You don't know what the future is going to be. You could really hurt yourself. And those kids, that hurt them. There was a little bit of a dispute over whether they wanted to keep it and operate it, but it was like they didn't have the depreciation. So they actually had income coming in off this thing. And they were like, oh my gosh, they had to do some fix up on it. There was some capital call issues. And so they decided they wanted to sell it. And instead of getting $1, they were getting 60 cents. And because it's not cheap to sell a building, you're paying the commission, you're paying the real estate tax, the closing costs, and all these things that eats away. Plus you're paying long-term capital gains on that thing. And you have a lot of recapture on the original building and the improvements that they had done thereafter. It ended up really hurting them. And it was shocking to look at it. And then I'm talking to the accountant who advised him the whole time. And I could tell he was like, oh, that was what the dad wanted to do. They overreacted to these law changes.